What is happening, people? Thank you so much for tuning into this video. A lot of people have been asking me lately, Steven, what are some of your top strategies? What are the strategies that you use day in and day out? What are the strategies that allowed you to become a millionaire investor? Well, a lot of them have to do with trading options. Now, I know people think options are risky, but they're not. Now, I don't want to jump right in this video and start throwing all these different strategies at you. What I want to do in this video is I want to talk to you about calls and puts. I want to give you a basic guide for calls and puts, and there's absolutely no experience required to be able to view and really get very, very educated on this video. So the goal of this video, give you a basic guide of calls and puts so that when we start talking about strategies that I use every single day and my market heroes use, you'll be able to have a very good understanding when we talk about calls and puts. So this isn't a very long video. It's only about 20-25 minutes or so. It'll be a quick one, but it'll be super, super helpful. This is your basic guide to calls and puts. I'll see you guys inside the computer. All right, everyone, we are inside the computer, ready to rock and roll. Now, most of the lessons that we've done so far, most of the videos we've done on this channel, the goal of those videos has been to not only educate you, but also to give you some sort of a takeaway or some sort of an actionable thing or item that you could do ultimately with the goal, because the only reason you're in the stock market is to make money, not just have fun, to make money. This video is a little bit different. It's very much just educational. However, this video, and we're talking here on this video about a basic guide to calls and puts, will serve the purpose that it serves is to educate you and to amplify the information you're going to be able to attain, the information you're going to be able to withhold and understand, and also the strategies and the actionable items in later on videos and other videos on this channel that have to do with trading calls and puts. So full disclosure, I trade calls and puts every single day. And in fact, if there's a day where I don't trade a call or put, I'm probably like in the hospital or something. I mean, that's how often I trade calls and puts every single day. I trade calls and puts every single day. The top money managers and the top 1% of all investors, they trade calls and puts every single day. My top students, my market heroes, everyone trades calls and puts every single day. Now, before we get into those strategies and before we talk about how you can use calls and puts to ultimately make a serious impact on your bottom line, you have to know what they actually are, what purpose they actually are used for by different people. And usually on my kind of introductory slides, I have a video of myself doing something funny. This is no different. This is me doing my best Derek Zoolander impression, my Blue Steel or my Magnum. It was funny, when I was getting these photos taken a couple weeks ago, I was smiling in every single photo, and the photographer said, "Hey, don't just like look at the camera like a model." So this is my best. This is my best impression of what a model would look like. So again, guys, most of the videos here on this channel are educational as well as actionable. This one's going to be educational with the idea that when there are actionable videos, actionable content, actionable live streams that use calls and puts, this educational video will serve as a stepping stone and will amplify everything else that we talk about on this channel about calls and puts. So let's break it down to very basic, right? Calls and puts are options, okay? Let me repeat that. Calls and puts are options. So what are options? Let's take it even a step further. Options. Now, they're talked about a lot on TV. They're talked about a lot on the internet. You might have seen videos of people trading options. You might have had people recommend that you go ahead and trade options. So what are options? Options, at their most basic, are nothing more than an agreement to buy or sell 100 shares of stock at a predetermined date and a predetermined price. So let's break this down a little bit better. Number one, options are nothing more than an agreement, right? So they are a contract, right? And this contract is to buy or sell 100 shares of stock. Every single option for a stock is worth 100 shares of stock. Right, so they're an agreement or a contract to buy 100 shares, buy or sell 100 shares of stock per every option at a predetermined date and a predetermined price. So at a predetermined date is the idea that options expire. And when the option expires, that contract is fully happening. It's not voided at that point. It's fully in play, that contract at that point. So at that predetermined date, you may have to buy or sell 100 shares of stock for every option that you own because of the contract or agreement that you had when you bought or sell it. And at a predetermined price, right, there are strike prices of options that are different than the current price of the stock. So depending on where the stock is, and how far or away it is from the predetermined price of that agreement or contract will determine if you have to buy or sell 100 shares of stock for every single option that you own. Now, two different types of people or two different types of investors deal with options. The first are your normal shareholders. And typically with options, shareholders use options to hedge their stock positions or improve off of their stock positions. And typically, larger shareholders are doing this. People that don't even have 100 shares of stock can't really trade options because they don't have 100 shares of stock. Right? And every single option that they would trade would be for the equivalent of 100 shares of stock. Thus, it's kind of too big for them. So you typically see the large institutions, the money managers, and the hedge funds trading options in and around their positions as a way to hedge their stock positions and improve upon their stock positions. So if you're looking at an options chain, which we'll show you here in a minute, and it has total option volume, any option that any stock that on a given day trades a few thousand contracts, that would give you a good indicator that yes, there are institutions, money managers, endowment funds, pension funds who are actively hedging their stock positions every single day in a certain stock. Now, the second type of person that might be interested in trading options that does it are known as speculators. So speculators are those who are not investing their money with the idea that they are funding public companies, giving those companies more money so they could take that money and they could use it on research and development, new employees, et cetera, with the idea that over the long run, the value of that investment will go up. Speculators are those that just bet on stocks going up or down, period, and there's no investment involved. And so speculators use options to place bets on the stock and utilize the leverage that comes with options, right? Options come with big time leverage. It costs fractions of a penny to have 100 shares of stocks equivalent with options. So these speculators go out there and they're able to swing around massive amounts of stock, hundreds of shares of stock, of synthetic stock, for fractions of the price, because options come with a lot of leverage. So again, as we kind of mentioned before, unlike stocks, which you can always buy or sell unless the company gets unlisted, how can a company get unlisted? Maybe potentially they get bought, maybe they get taken private, or they become bankrupt. So unlike stocks, which are always available to buy or sell unless the company gets unlisted, options expire. Remember, a predetermined date. Options expire and are untradeable after they expire. Makes a lot of sense. Let's go and take a look at an option chain real quick. So SPY, the S&P 500 Index ETF. And what we see here is an options chain. Now, part of what we mentioned of what an option is there an agreement to buy or sell 100 shares of stock, right? So they're a contract at a predetermined date, right? So let's take that part and put it into context. Predetermined date. Right here, I mean, today is December 9th. We see all the different options expiration cycles, right? An option is found and is traded in a certain expiration cycle that expires on a predetermined date. right here on the left side of the screen, we see the various options chains. We have some that are known as weeklies that expire on a Friday. We have some that don't say weekly, and they're here in white, and those are the monthly expiration cycles. Options in the monthly expiration cycle, they expire on the third Thursday of every month. So right here, the December, these options expire on the third Thursday of December. These down here expire on the third Thursday, or excuse me, on the third Friday of January. So the dates that come with these, for example, this cycle is December 20. So all options in this cycle, remember predetermined date, expire at this predetermined date, which is December 20th, 2017. And now, at a predetermined price, right now the price of SPY, the price of the stock is at 265.51. However, all of these different options have these different strikes. So right here, this is a 260 strike. So depending on where the price of SPY is, on the date, the predetermined date that the contract or the agreement expires, the option, depending on where the price is, you may have to buy or sell 100 shares of stock for every option you own or are short, depending on if you have calls or if you have puts. And don't worry, we'll get into these individually here in just about a second. So again, this is what options are. Shareholders use them to hedge and improve their stock positions. Speculators use them kind of like the Wild Wild West because they have pretty excessive amounts of leverage, and that allows them to just place directional bets, place bets on the price of the stock, etc., etc. And again, they're nothing more than an agreement or contract to buy or sell 100 shares of stock for every option at a predetermined date, which we already talked about, expiration cycle, at a predetermined price, which is the price of the option. Predetermined date, the 20th of 2017. Predetermined price, 260, right? And that's what it is. That's what an option is. So then what is a call? Remember, this lesson is an educational lesson, is an informational lesson, right? A basic guide to calls and puts, talking about calls and puts so that it can amplify everything else that you learn on this channel when we get into strategies for calls and puts. So what is a call? Right? So this is an options chain, and again, I use the Thinkorswim platform by TD Ameritrade, and what I want to do is I want to make it just a little clearer here for you. Right? This is an options chain that I use. Again, I use the Thinkorswim platform. I always have used the Thinkorswim platform for well over a decade, and always will continue to do so. What we see with an options chain is right here, we see all the different expiration cycles on the left hand of the screen. Below it, we see today's option statistics, where it tells you how many calls were bought or sold, how many puts were bought and sold, and then what the total is. Remember, we talked about how can we tell that money managers, hedge funds, institutions are involved in trading options on a stock? We would see a few thousand contracts traded total in a day. Right here we see about 2.5 million. So clearly in SPY, which is the index ETF for the S&P 500, we know that institutions, hedge funds, endowments funds, pension funds, big-time money managers are very, very involved in the buying and selling of puts and calls and options to hedge their positions as well as improve on their positions. Totally makes sense. So let's dig into calls. All right, we're talking about calls. So what is a call? Well, a call itself is not an agreement to buy or sell something, depending on if it's just a call versus if it's just a put. It depends, right? The agreement to buy or sell something depends on if you're the buyer or the seller of the call. So for a call, buyers of calls, right, they benefit from the price of the stock going higher. If you buy a call, you will make money if the price of the stock goes higher. If you buy a call, you are synthetically long a certain amount of shares of stock, right? And if you're long a certain amount of shares of stock and the price of the stock goes higher, you have made money. Right, so buyers of the calls, what they're doing, remember, they're agreeing to buy 100 shares of stock for every one call they purchase if the price of the stock is above the price of the option when the options expire. Right, so they're agreeing to buy 100 shares of stock at a predetermined date, right, when the options expire, at a predetermined price, if the price of the stock is above the price of the option. So going back into our options chain, let's look at the 266 call and SPY. So right now, the price of SPY is 265.51. The price of the option is 266. So if we were to go ahead and buy, the 266 call, sorry, I'm just trying to make this so it looks a little, the 266 call, we would be paying about 76 cents. That's the ask right now. Remember, the bid is the lowest amount of money someone is willing to buy for, and the ask is the lowest amount of money. Excuse me, I said that wrong. The bid is the greatest amount of money someone is willing to buy for, and the ask is the lowest amount of money someone is willing to sell for. So for the 266 call, the most someone is willing to pay for right now is 70 cents. And the least someone is willing to sell for is 76 cents. So if you want to buy it, we're going to have to pay 76 cents because right now that's the least someone is willing to sell for. So what happens with this is we pay 76 cents, and if the price of SPY is above the price of our option, 266, in the next 6 days, we will make money, or we will be the right owner of 100 shares of SPY at 266. So if the price of SPY is at 268 in 6 days from now, we will have gotten the opportunity, if we want, to buy 100 shares at 266. Remember, the price is going to be at 268, so we are already a $2 winner on that trade. Right? So that is what the buyer of an option looks to do. Now, obviously, when you buy an option, someone is willing to sell, which is different than a seller. So we have a seller of calls that benefit from the price of the stock going down. So the way it works out for a seller is sellers of calls are agreeing to sell 100 shares of stock for every one call they sell if the price of the stock is above the price of the call option when the option expires. Right, so we're looking at buying the 266 call, and now let's look at the opposite. So we would look to sell. Right, so remember, the bid on the 266 call is 70 cents. That's the most someone is willing to pay for that call right now. The offer, the ask, is the least someone is willing to sell the 266 call for. Right, that's 76 cents. So if we're going to go ahead and sell it, we have to go to the most someone's willing to buy for. That's 70 cents. So what happens here is the seller of the call will make money if the price of SPY, which is at 265.51 right now, is below 266 6 days from now. And the same example we used last time, if SPY in 6 days from now is at 268, the seller of the call has to sell short 100 shares for every option they have sold, every 266 call they have sold, in which case they'll be a $2 loser at the onset of the trade. So that's what a call is. And remember, it's different whether you're the buyer or the seller of the call. Right? That could be the same thing can be said for a put. It is different. The buying or selling at a predetermined date at a predetermined price is different based off if you're the buyer or the seller of the put. So the buyer of a put benefits from the price of the stock going down. Remember, if you're the buyer of a put, you are synthetically short a certain amount of shares of stock. Right? So if you're short a certain amount of shares and the price of stock goes down, you would make money here. So the buyer of a put, they're agreeing to sell 100 shares of stock for every one put they purchase if the price of the stock is below the price of the put option when the option expires. So let's take a look at this side. So right now, the 264 put is 93 cents. In order to buy it, we have to pay what the ask is, which is the least someone is willing to sell for. Remember, we always have to buy from a seller, 93 cents. Now, what buying a put in this situation says, in 6 days from now, we have bought the 264 put. The price of SPY right now is 265.51. So if the price of SPY finishes below 264, then we are able to sell short 100 shares of stock at 264. So if the price of SPY is at 260, for example, 6 days from now, and we are long, we have purchased this 264 put, we're able to buy at 100, we're able to sell, 100 shares of stock and be a $4 winner on the onset. Right, so that's what the buyer of a put is, and obviously the other side of the coin is the seller of a put. Sellers of the put benefit from the price of stock going higher, right? And sellers of the put, they're agreeing to buy 100 shares from the buyer of the put for every one put they sell if the price of the stock is below the price of the put option when the option expires. So if we do the opposite here, I'm just going to sell it. We are going to be able to sell that 264 put for 90 cents. That's the bid. That is the most someone is willing to pay or buy the 264 put for 90 cents. So the way it works out is right now the price of SPY is 265.51. These options expire in 6 days from now. So the way it would work is if the price of SPY is above 264 6 days from now, the put buyer will lose money and the put seller will make money. If the price of SPY is below 264 at expiration, let's call it 260 again, the seller of the put will have to buy 100 shares of stock at 264 and be a $4 loser right off the bat, right? Right off the bat. So let me ask you two quick questions and then we'll wrap up again. This was to serve as educational purpose so that it could amplify everything else that you're viewing on this channel that has to do with buying or selling puts and calls. So, what if we want to bet the price of the stock goes higher? What could we do? We could buy a call or sell a put. Remember, buyers of calls are synthetically long shares of stock as well as sellers of puts. Both of those situations, you're synthetically long shares of stock, thus you benefit from the price of the stock going higher. Second question, what if we want to bet the price of the stock goes down? We would buy a put or sell a call. When we buy a put or sell a call, we are synthetically short a certain amount of shares, right? And if we're short shares, we make money if the price of the stock goes down. So in a nutshell, guys, that is what puts and calls are. Again, the purpose of this video is to educate you so that it could amplify and add to the benefit of other videos and other content you're going to see on this channel, which are actual strategies utilizing the buying and selling of puts and calls. So I hope this was helpful. If you guys have any questions, comment in the comment box below, and I'll see you guys on the next video.